The US dollar is currently testing levels that it hasn't actually seen since the beginning of the month. So guys, really interesting price action just generally this month for the dollar. A lot of these fundamental themes that have been driving dollar price action have evolved this month and they have lent more support. So let's just quickly recap really like the last 2 months of dollar price action. You'll remember back in May and the beginning of June, dollar was getting slammed and Dixie fell as low as beneath the 96 level. Why was dollar getting slammed? Well, there was a couple of reasons. Like number one, probably the number one reason was massive risk on in the stock market, AUD, NZD, crude oil markets. All of these risk assets were absolutely surging because economic reopening, we were getting economic data that was better than expected, and that was just generally weighing on havens, including the dollar. There's also that improvement in Eurozone sentiment with the EU leaders moving closer to that EU recovery fund deal, so that was a big help for euro. Obviously good for euro, normally bad for dollar. And also, there's just been this ongoing narrative, and this is still ongoing, that the Fed is just the most dovish central bank in the world. When you look at the rate at which they're expanding their balance sheet, the way they're printing money, they're outprinting all of the other major central banks, which, you know, in May and June, everyone was saying, oh, the dollar's got to go lower just because of Fed dovishness, it's got to go lower. And that was what we saw. But why the shift in sentiment? Well, obviously, we've been talking about this all month, so I'm sure if you guys have been watching our blogs, you will know this, but there's been this resurgence in cases of coronavirus in the US, and that is the primary reason why risk assets this month have actually, I think they're mostly flat or maybe a little bit lower if you look at the US indices. They're not massively moved, but they're much more cautious compared to May and April, where they made massive gains. And it's all a reflection of increasing risks of a second wave of coronavirus. Also not helping is rising tensions between the US and China, between the US and Europe. You know, that same old theme we've been talking about for a long time, that's not helping either. But the primary thing is this resurgence in coronavirus cases. So all of these fundamentals that I've just been talking about might sound a little bit like, whoa, that's a lot. So what does this all mean for the dollar going forward? And unfortunately, it's a tricky one because you can make arguments both ways. For example, if this risk asset rally continues to weaken, risk asset stocks go lower in July, you know, AUD, NZD, crude oil markets keep heading lower, well then that should support havens. You know, why would risk assets go lower? Well, it could be, you know, this second wave of coronavirus continues to worsen in the US, continues to worsen around the world. Maybe it comes up in Europe as well. And that should be good for the US dollar. However, there are, you know, threats to this view, such as, what if the EU surprises us and they agree that big deal on the EU recovery fund? Well, you'd see massive euro strength, and that would be bad for the dollar. What if Europe continues to contain the coronavirus really well, and you know, in America the spread just keeps getting wildly out of control? Well, that actually could be dollar negative to reflect the US economy's weakening position. All the while, the Fed, like I said at the beginning of the video, still very dovish. They could do more. They could do more stimulus, which could weigh on the dollar. So a lot to think about going forward. You can make a decent argument that the dollar is going to go higher, but equally, remember the risks to the downside. That is pretty much it from me for now, and I will see you in the next one.